All right, everyone. Welcome to the Story Trading VIP Weekly Meetup. Just a quick reminder, Story Trading is not an investment advisor. That goes for all of our guests as well. Investing in securities involves significant risk of loss. This event is being recorded. It's going to be provided to our VIP members for a period of about 7 days, and then we'll post this up on our YouTube channel thereafter and Spotify as well, actually. All right. So agenda, we'll do a macro discussion. I'll do a quick, very high-level overview of a couple of my thoughts, but then we'll spend the bulk of our time with Vince Kapadia to go over his chart, since he was here last week and everyone loved him. And so I asked him to come back, and he graciously taken some time from vacation to be able to do that. And we'll get Chris Tarber on CLFD. He did do a mini presentation for us in one of our morning shows last week before earnings. Actually, a late morning special edition show before earnings. Earnings came out. It looks to be good. So he's going to give us an ER review of that. And then I'll give you some updates, some due diligence and nugget updates on Seek, Drio, CFEI, and Kodak. So first, quick on the macro. Look, I'm going to keep my view very simple here. Just going to show you two charts. This is ARK, and this one's Nasdaq. And basically, my thesis for a long time has been that the excess liquidity and the COVID gains that came had to also come out of the mega caps and the Nasdaq. So we saw it happen at ARKK first, and I've been waiting for a long time for that to happen for the mega caps next. And I've been postulating for a while that the trigger would be Apple with a weak guide. So what we ended up happening on Thursday, on Friday, is we had Amazon down 15%. Not on necessarily weak consumer discretionary spend, but I guess they have some cost headwinds because of inflation. So that was down 15%, which is a crazy, crazy number. And Apple was weak, even though they had a great, awesome report. It kind of died, and it's a little bit weak now. And it kind of did what I expected in terms of the report, where the report was great, but they refused to give guidance, particularly on that question. Was the first question analysts asked is, do you see softening demand from the consumer because of inflation? And they skirted that question, and the market didn't like that. So Apple also did reverse and was down a few percentage points instead of up on a great report. But acutely, at least, you see QQQ breaking that 316 low was due to Amazon being down 15%. So look, at the end of the day, I think you got to get rid of that COVID excess and at the least get back to this 200-week moving average. That's my view on that, but who am I? Because we got Vince. So Vince, why don't you take it away from here?
Great. You want to enable me sharing the screen?
Yeah, go ahead.
Okay. You guys can see this?
Yep.
Okay, so I'm going to start. I'm going to do a top down. This is the Dow Jones Industrial Average. Okay, going back to 2000, and I think it's my glasses with me, but I think it's 2008, the Great Recession. All right. So again, I do use moving averages. But the problem with moving averages, once the market turns to the downside, the moving averages become resistance. So it doesn't really tell you which way we're headed. The only way you can do is work backwards and see if there are any trends. And there's one trend I found. And if you take the bottom of the Great Recession, you take the bottom of the 2018-19, the last time we had a pretty nasty market when the Fed started hiking rates, and then the bottom close of the Great Recession, when it went down, you do see a bottom, you see a certain trend line. That puts the Dow at 26,000. Do I think it goes there? I don't think so, unless we go, I don't know. I'm not going to forecast anything because I don't know myself. It's going to be based on whatever economic data comes out, what the Fed does, and the market's interpretation of the Fed's actions, all right? I do have a concern that inflation is very high, and they may say, we're going to do whatever we can to kill it. If that does happen, I think 30,000 is a given. I really do. I think 30,000 on the Dow is a given. I'm not sure.
Is that another 10% down?
Yeah. We're at 32,977. 30,000 would put us here. which, that puts us in a trend prior to COVID, but that assumes a healthy market. If we're in a recession, then here's your recession risk right here. You said you wanted to quantify it. This would be it, because this is a black swan event, and this is the last time we thought we were going into a recession, and this was a recession, great recession. So you've got certain, now obviously we're in a upscaling trend here, but this is where I think we could go. I'm not sure. Here's a more of a detailed one. This is a little bit more zoomed in, and this is the upward channel on the last chart. Again, this is the 2017 bottom here. Again, the 19 crash, we came up, and I did the VWAP from both lows, the 2019 correction and the bottom of the 2020 crash. Okay, both VWAPs, one's at 30,000, the other one's at 28, 29, and coincidentally, the 200-day moving average on the weekly is also in the same area. So 30,029 is, I think it's, if I'm gonna buy some long-term leaps or diamond calls, I'm gonna start here. Okay, that's the Dow. Okay, this is the Nasdaq. Now we've gone over this a couple of times. It's nasty. It's, I don't know where it's gonna go. Weekly, at least juncture, the only thing I feel consistent or confident with is probably 11,000 is not out of the woods. Okay, and that assumes we don't dive into a recession, because the 200-day weekly and the bottom channel here both around 10, 6 to 11. 12 is a given. We're already here. All right. So there's not a whole lot to say there because it's ugly, and I don't want to pick a bottom. But if I were to start, I'll probably start somewhere here. All right.
And that's about, I think I did that math before, to the 200 weekly, I think is about 18%. Does that sound right?
We may not get there, but let's prepare for the worst. But, we are in a...
I hope that's the worst. That's not bad. I'll take that.
Yeah.
I mean, it's like we're over halfway there.
This is more of a detailed chart. Same thing. I've zoomed in. Again, you will see the weekly comes in roughly about 10.6. I don't know. We're not that far off. Listen, we have another month of this. We're there. Mm-hmm. Look what it's done in the last 4 weeks. We went from 14.5 to 12.5. That's 2,000 points. Another month we're there. And one thing that history has shown me is that corrections, information travels faster. If you go historically, things occur slower. Going forward, they occur very fast. So that's one thing I have seen. All right. Here is, what's this one? This is the NDX, Nasdaq 100. This is zoomed in, going back to 2017. Sorry, I don't have my glasses with me. But we're coming into a decent area. Again, the 2018, I keep on referencing the 2018-19 correction and the 2020 pullback in March 20. Why? Because those are the only two areas of empirical evidence that we can use for trend analysis. I can use moving averages because moving averages, the indices on the stocks are going to be below those. So there's no sense in using them because they're going to be future resistance. So I use channels. I may be wrong, but it's worked for me in the past. I think NDX is 11, no problem, maybe 10 and change. We'll see. Here's more of a zoomed, same thing, 2019 here. All right. I did draw a little extra bottom channel here saying, okay, let's say the market always overshoots. If it does, 10,000. I don't think I'll get there, but we'll see. But we're
10, where now? What's our level now? Can't
12.6.
12.6?
Yeah. This is the NDX, Nasdaq 100.
Okay.
And here is Puru's chart. This is Puru Saxena, I've been, one of the reasons I got out back in November because of this guy. So he's saying 12. Historically, that's met. I don't know, because I think this level of valuation far exceeded the .com. I just think, I don't know, we'll see. If we stops at 12, I'll be happy. I just don't see it. I'm thinking somewhere here, but we'll see. So that's the NDX, okay, Nasdaq 100. let's go to S&P. So S&P has not, it's corrected, but it's not corrected in the fashion that I thought it would. Why? Because it's heavily indexed with the big boys, Microsoft, Google, Apple being the sole one. So again, this is the zoomed in version, 2018, 2020, okay? The 20 weekly is coming at 34.61. Now, if you look at January, and I put it on the WhatsApp chat group, I said back in January, don't be surprised if we hit, 3,800 to 4,000 just using basic correction pullbacks from last periods. And look, 3,800 is not unreasonable, folks. We're going to get a test of 4 here real quick, all right? It's going to depend on what happens in the next week or so. I don't know when it's going to happen, but it's going to happen because there's nothing here that tells me that we're going to bounce anytime soon. I don't see any indicators telling us we're going to bounce. I just don't. If anything, we're going to test this. We may bounce there, and then it's going to be another test, and then it's going to depend on the economic data. It's going to depend on the Fed. It's going to depend on inflation and rates. And all of those are going the other way. They're headwinds. So there's nothing to the upside that's going to help us go back. Okay, here is the QQQs, all right? VWAP from 2018 pullback, VWAP from the March pullback. We've already breached the March 2020 VWAP. What's next? The March 2018, that's at 279. 300 test is coming, all right? That's a no-brainer. I will have no problem buying some leaps on the QQQs in this channel down here. I still think that there's too much excess in the Nasdaq. I think it's going to depend on Apple. It's so heavily weighted, and Microsoft. So it's going to depend on those. All right, but I'm not going to get aggressive. I'm not getting aggressive anytime soon because I don't know how long this is going to last. This could last quarters, and we'll get into the fear part because fear will also help accelerate this correction, and we want that. We want. Ideally, what I would want is a flash crash. We got our medicine, it's really bad, and freaking it out, break all the charts, and we bounce. I just don't see that happen because there's too much liquidity in the market still. And we're gonna get this constant erosion, and it's like someone pulling your toenails out.
Are you quantifying that somewhere when you say too much liquidity in the market?
No, I have not been able to quantify it. I could just, that's
just what you feel?
It's a gut. I don't have anything to quantify for that.
Yeah.
I don't think anyone does. At least I don't know. Okay. This is one chart that's really intriguing to me, and I'll tell you why. I think that IWM is going to be coming close to a bottom pretty soon here. And there's something I want to talk to you about ARK also. So this is the main channel going back to 2006 or 7, I believe. Let's see. This is 2008, the Great Recession, all right? This is the channel created from there. The only time we breached it was, again, 2018, but we bounced right back. And then we had another one in the 15 one. There's one in 15, I remember. And then there's one in 18, the crash or pullback for the Fed last start had that hike. And then the Black Swan event. If you take a VWAP from the March 2020, that's going to be tested soon right here at 178. The 2018-19 crash VWAP is already, actually, that's the one that's going to be tested. The March 2020 has already been breached. So here's what I'm thinking. These guys have been beaten down so hard. This is the excess from the COVID. And the IWM and the small caps were flashing warning signs in February and March of last year. They just weren't doing anything. They were the first ones. And their pullback is substantially more than the S&P and the Nasdaq. So the minute this starts not going down to the same degree, then I think you're gonna get some clue. I'll probably start dabbling here in the 160s if I can get one. And if it goes here, I'll buy long-term leaps in the 120s. And there's I don't know what you call this, a monthly 200-day, I don't know what this is, but that's at 111. I don't think we get there, but I think somewhere, I think that we're going to be, once you get down to this 160 level, I think that there may be some short-term, hopefully some bottom. Because remember, this is going back to the Great Recession. All right, this is our economic conditions are horrible, and for it to break this bottom band, there's got to be something really wrong, really wrong. So I just don't think our economy is like that. Here is a zoomed in chart of the same IWM VWAP from 2018, March 2020. Well, they're both gonna get tested soon, and I think this is the uglier chart because they really didn't have as a dramatic run up. They've already corrected going back to 2000 and what is this? October of 2020. Already back there. That's the IWMs. And I'm gonna talk about ARK because it's somewhat related to this in a bit. Okay, so here's a SOX index. Now, to me, the SOX is very important because it's the backbone of the tech hardware industry. All right, it's been the leader, but it's taken out the first March 2020 VWAP. It's going to be coming into this long-term channel from 2018. Well, actually, it goes back there, but that's the indicators. Now, I don't form the channels, guys. I just look at the charts and I look at the highs and the lows. And obviously, March 2020 is not really applicable, but I did take the low from the 1819 pullback to the March 2020 lows as a worst case scenario. And that puts the SOX at 240, which is still a substantial ways down. I hope it doesn't go there, but I think the VWAP tests are coming. How far it goes in the channel, I'm not sure. And maybe, Ben, towards the end, you want to put this in a PDF and send it to all the members, wherever you want to go out there.
Yeah, I could do that. I got them already in the PowerPoint.
Okay, so this is the SOX XL, which is the SOX triple leveraged. And obviously, when you're triple leveraged, you're going to get hit pretty hard. This hit 3 in March 2020. It's to 22 from 74. All right, so could it go 15? Sure, easily, very quickly. So keep an eye on XOXL. All right. Okay, ARK. This is what intrigued me about ARK. All right. This is a short-term pattern going back to March of. Oh, this is March 2020. There's another one I want to show you first. Hold on. Okay, here it is. So I looked at ARK going back to 2016. The low there was the last time we had the small caps got really hit hard. We got 15 bucks. All right. And then if I chug along here, take the ultimate low from March 2020, which is Black Swan event, we thought the world was ending. We're coming pretty close to a trend line hit, which tells me two things. Either Kathy is not managing her fund the same way, she doesn't have the same instruments, or she's changed her weighting, or this is another indicator that the small caps and the growths are pretty close to bottom. I don't know, but can someone do a present value analysis? I was thinking about this before. If we take 2015, it was a 2015, let's say we use 15 bucks, and that's present value, and let's use a future value of, let's say, 40 over 6.5 years. What's the compounded rate of return? 16 or 17%, I would guess. That's a very low return for small cap companies in ARK that are growing 40, 50%. So all I'm trying to say is, as a business, just as a layman businessman, someone says, okay, I want to give you an investment that's you're gonna be in it at 14 or 15 bucks a share in 2015 or 16, and today it'll be at 38 or 40. What's the internal rate of return? It's probably around 16, 17%, which is not that high for ARK. So what that tells me, either that she doesn't know what she's doing, she's changed the weightings, all the companies she's picked are diving, or we're coming close to a bottom, because that growth rate over one of the biggest economic boom periods doesn't make sense. So that's one indicator that says we could be coming close to a bottom. I'm not sure. Anyway, this is ARK zoomed in. 33 was the pandemic low. We breached that trend line. So, where's it going to go? I don't know. We go back to 33 and take a look at it. I don't know, but there's nothing in ARK that tells me that it's bottomed. but right now, I mean, it's ugly. This chart tells me it's ugly, but this chart tells me that it could be coming close. But you know, it's an index. It could go to zero. We don't know. But I would be touching this before any of the big mega caps, and I'll tell you why in a sec. All right, this is Google. Look at Google's long-term channel going back to 2014. It's been a very consistent channel, breached a couple of times, and we're finally getting back on it. Now, I'm a big fan of Google. I have it in my retirement about a long time ago, and it'd be painful for me to see it here, but if it goes, I'm buying. More than likely, I'm going to buy. Listen, there's three companies that are pricing power, Amazon to some degree, Apple, Google, Tesla, and these guys. If you have pricing power, you can probably do well even in a recessionary environment. The 200 weekly is at 1677, but this thing scares me. It really does. I don't think I've ever seen Google act like this. So we'll see. I'll probably do some ads here and then another ad down there and see what happens. This is not a market you can call a bottom. You just take some incremental baby steps and see what happens. Here's a March 2020. VWAP's at 2083. It could get tested very quickly. Weekly on here is 1724. This is a company that it'll continue to grow, and if you invest in it for the long haul, you'll be fine. But depends what your time horizon is. All right. If you have it at a high price, you can sell calls. Okay, this is Amazon, very ugly. I don't know what to say about Amazon because any analytics I throw at it, it looks ugly. This is October of 2016, right? It's already breached the channel from COVID. Now I'm going back to 16, connecting all the lows, and it could take that out next week. If it does, I don't know what to tell you about Amazon. I'm hoping that that's the same trend line. I'm hoping that because it's not going to be in the retail component. It's going to be the AWS and cloud that's going to drive the growth. You know, the retail growth was here. That's done, folks. COVID's done. We're not ordering a million things. We're not drinking in Prime. We're actually going to be going out. So that era is over. So I don't know. Amazon is a big company, and that chart looks ugly. Hopefully it bounces here. I don't know if it will. Okay, Tesla. Oh boy, Tesla is really concerning to me to a certain degree. Like I said last week, so here's this line that I had since March of 2020, and it's always been there up until obviously the recent pullback. But this does not appear to be being sustained by the stock price. And they've done nothing but positive things. Amazing earnings, blew all the estimates away, stock split being announced, but it's just not acting like it should, which tells me that the market is starting to discount the valuation. So how do we handle this? I don't know. To me, there's more action in this downtrend than going up. So I took up my lines going up, and I'm going to keep this downtrend in place. Hopefully it bounces and a new uptrend is formed on this bottom, on this white line. 900 to 1,000 is an important point. It's acted relatively well in this correction. I will say that. But I don't want to see VWAP tests because those VWAPs are really low. And the reason that is because it has had an exponential run up. It was up 700%, I think, since 19. That's some crazy number. So Tesla is concerning to me. Here's a zoomed chart of Tesla. Now on this VWAP, it's at 568. If I'm a betting man, and since I'm in Vegas, I'm going to make a call. There's a highly stronger likelihood it goes here versus here, based on what this chart is telling me. It just don't look good, and it pains me to say this because I'm a stockholder in this company, but it's got a high multiple, And if the stock market's discounting everything, they're going to discount Tesla. I hope it doesn't go there. Okay. Here is Microsoft. Microsoft is as clockwork as you can get. Okay. This is going back to 2016, I believe. Sorry, this is another chart I put out. Did I put the other one? Yeah, this is the longer chart. So this is going back to 2000 and, oh no, sorry. Sorry, folks. Okay. This is going back to 2000, my mouse is stuck again. 2018. It's hasn't had the exponential run as the other companies because it's obviously off quite a bit, but it's come back in this channel. It really didn't go out of its main channel dramatically at all. You go back to 2018, it's been a consistent, strong company. They had earnings, they almost saved the market, which basically they did last week. If it tests this first VWAP and the second, I have no problem buying this because I know Microsoft's going to be around. That's another company that has pricing power. So I have no problem because the market's corrected. It's still going to correct. Will it go lower? Sure. I have no problem buying at 245. And even if it goes lower, I'll still hold on to it.
I can add to that about the pricing power. It's also because it's not consumer discretionary. This
Correct.
is like
not only
necessary software for
and like we're on Zoom.
Productivity.
But we're on Zoom, but they're going to go after Zoom next. From what I understand, I have friends that work there. One of the reasons why Zoom is probably going to be in trouble. Okay. So this is just short-term. This is 2018. Let me go back to the short-term chart of Microsoft. Here it is. This chart will tell you pretty in detail where it could go. I mean, buying at a test of the first VWAP, the perpendicular parallel test of the March 20 to its channel, and then the 2008 VWAP. These are all good technical points to buy. I'm not saying go all in, but you can start dabbling. And the 200 weeklies at 200. If you have a flash crash and Microsoft down to 200, that's the first thing I'm buying over anything else. Okay. NVIDIA. Ooh, the chips are in trouble, folks. Their chips are in trouble. If you look at the SOX index, you look at what LRCX said, you look at the SOX XL, you look at AMD, and now you look at NVIDIA. It scares the shit out, scares me quite a bit. Okay. 2018. Okay, let me show you the long-term chart on this one. No, I need to do long-term. Okay, this is the 2018. Oh, that I couldn't do a long-term because this thing, again, this is another pretty exponential grower. I mean, from 2020, it was at about 80 bucks pre-COVID. All right. You're talking about what's the damage on what's the pre-COVID high? Pre-COVID high on this is 80. And it went all the way up to 346. If anything's going to come down the most, it's probably this one. I mean, this is how scary this one is. If we take the March 2000 the pre-COVID high, which is consistent with the last time it went down before the 2018 crash, we line it up, we're below all the indicators that I have on this one. So I'm not touching this one anytime soon. I love the company and they're growing phenomenal, but and they have had amazing earnings, but look what the market's done. Market is a discounting machine and discounting the crap out of this one. So maybe take a shot, maybe take your first step between the VWAPs, I don't know. But nothing looks good. Okay, Facebook, they have a lot of cash, and I'm not sure, this is a pretty vicious decline for a company with its exposure to consumers and the social media and Instagram. So I don't know, I mean, if I connect the lows of 2000 and the first mega cap or small tech pullback here, and then the 2018 and the 2020 gets me around 160, which if you're a technical analysis, there's nothing else on this chart that will give you an indication to buy except this trend line. Nothing else. So maybe take a stab at it there. I don't know, but there's less downside in the beaten up stocks than NVIDIA. Netflix is just ugly. I don't know what to do with this one. This looks like a company that's going bankrupt the way the stock is acting. But I'll be willing to take a shot here around 136 if I can get it. It's a profitable company. The market is just 700 to 136. I'll take my odds on that. I really will. CRM is something that I have owned for a long time. It's in my retirement account. I bought it a long time ago, and I'm probably going to start adding pretty soon. This, when it gets into this channel, because this trend line is going back to 2011, folks. 2011. All right, and it broke out, and this channel never got breached. It breached temporarily, but it never closed. This is the March 2018-19 and the March 2020 lows. You connect those, we're here. I have no problem buying this at 120, 140. This is a Dow component. I like Salesforce at this price, absolutely. I'm not going to go all in, but I feel very comfortable buying here. And it's giving you the opportunity, especially if we have a crash, like a flash opening gap down. Probably Microsoft and CRM will be the first ones. Okay, Apple, you know, I've owned Apple for a long time. I think it's just got to do its thing. I think eventually, I said a long time ago, 120. I still think it's going to go there. I don't know when, but it's got to breach. Now, I actually started this down channel. We'll see how it goes. But Apple, when Apple sneezes, the stock market will catch a cold. So we got to see what happens to Apple. They're all going to be about earnings and how they're very much heavily into discretionary consumer products. We'll see. I mean, I know they made a big push towards software and subscriptions, etc. But I don't know. This still has to come and test the March VWAP and the 2018 VWAP. So 120, maybe even too high. I don't know. And then now let's talk about, what's this one? Oh, I put an SMSI in here because I thought, Ben, you wanted me to talk about it. I don't know. That, like I said last week, there's not a whole lot I can do with this chart. It's breached anything that I would look at. This is going back to July of 18, and it's below that. So I don't know what to do with this.
Yeah, the reason we're looking at all the big caps and the indices is because there's an unmistakable correlation between the performance of those asset classes and the micro caps and risk assets like SMSI. It's just, you can't deny that, right? Yeah. You see that on a day-to-day level. So it's like, what happens if, you see how much more room Amazon has to fall, or Google or Apple? What's going to become of stocks like SMSI? Are they going to catch a bottom with ARKK and IWM, or they go much lower? It's a little concerning. I'm not sure I have the answer to that.
I still think the growth stocks are not going to, at a certain point, and it may start happening sooner than later, I still think that excess is going to come out of the market. It's going to come out of the most richly valued companies first. And those companies that have been hardest may not continually. I don't know. I'm going to wrap it up with VIX. I think VIX is about to start soon. This is what concerns me about VIX. We haven't even seen high 30s, 40s yet, and the market's down 900 points. It's like inching up. There's just no fear. There's no fear at all. And to me, fear is, I'm a contrarian when it comes to the stock market correcting. When there's massive fear, and you get a 40 plus, 45, or maybe 50, then I would probably close my eyes and start buying some long-term leaps. But there's just not enough fear. I mean, we've had, since 2021, okay, we've had this is the March, I think this is the March pullback, right? It went up to 37 or 30, and we're in worse off shape now than we were back then. And VIX is lower. So there's the fear is actually less than the March low and some of these spikes we've had, which is concerning because market to me, my interpretation of the market is perception, sentiment, and forward looking. And those three elements are worse today than they were back in March when they had the pullback, and VIX is not high enough yet, which tells me we still got more pain to go, which is not a good feeling. But sorry. So that's all I really wanted to go over is just, you know, top down where I see things are at. This is not a market where you can buy and pick bottoms. It's not that. Bottoms are not made on a Friday. They're made on a day where we gap down and we make an attempt to pull back. If a market gaps up like on a Monday or a Tuesday, that is not a bottom, because a true test, I've seen it so many times, is a gap down, we file our way, and we have a couple of those tests. We haven't tested anything yet, and we're not close to a bottom. I would hate it if we gap up, because that just means it's going to get sold off again, unfortunately. But the good thing is, there's one positive out of this, is that we are technically very oversold. So if you're in that camp where you're going to start to make some of, at least capitalize on the market rallies, you're going to get some opportunities to sell some calls to collect some cash flow on your positions you may be down on. And I think that's going to happen. The Fed is going to make a statement on Wednesday, so something's going to happen. I don't know what. Usually when Powell speaks, the market doesn't like it. If he says 75, that's not good. That's just not good. And the problem is we've never had inflation this high. So we've almost got a perfect storm, because if the Fed really wants to, they may have to kill the economy to kill recession, to kill the inflation. That's also concerning. So I don't know. I just wanted to go over some of these basic charts. I know there's a lot of them. I got some trend lines. Is my interpretation. These are not indicators of usually I should buy at these points. This is strictly my analysis of trend lines, how I'm looking at it. I'm not investing anything heavily at all. I'm just waiting and letting the market tell me what I think is going to happen. And right now, there's nothing that tells me we're going to bounce. Technically, we're oversold, and we may get some bear market rallies. So.
All right, Vince, that was awesome. There's a couple questions which I want to go through super fast because we're running late. First one, let me just take a stab at it. You can ask, but Sanjay asked, why are semis doing so bad? I think you spoke to it. It's because they're up the most since COVID, right? They had the biggest jump since COVID, and they have the most to fall. He says fundamentally, do you agree with me that this is semis, the SOX index is consumer discretionary?
I think it is to a certain degree, but I think something has to do with China. I don't know what's causing it. I just don't know what's causing it. Again, my weakness is fundamental. That's why obviously I joined StoryTrading. I'm great in technical analysis, but I don't know why they're going down. All I know they look pretty weak, and the money's leaving. So why are semis doing so bad? I think it's something related to the chip. I don't know. It could be related to chip shortage. It could be related to China and Taiwan. I don't know.
Bart has an interesting question that I'd like to chime in on, because I'm pretty convicted on the answer to this one. I've been talking about it. Is it possible that fear exists in the market, but investors are shying away from driving option premiums up because of uncertainty or lack of conviction?
Yeah.
And
Bart is actually very, very astute, and that also is a reason, because when I go look to I looked at the option pricing for them, and it's horrible. It sucks. So he's right. He's absolutely right. They could be doing that.
What are you seeing about the option pricing?
When you look at, like, sometimes when VIX spikes, I try to sell put options on it.
Right.
And I do my internal rate of return analysis. The returns are horrible. So what he's saying is that investors are shying away from driving up option premiums up. He's right. The premiums are not that expensive. So I don't know what it is. It could be a lack of conviction, or maybe no one knows. See, I just don't think anybody knows. I think the market is scared. The market's never seen inflation this high, at least in this decade or the last decade. You have to go back to the 1980s, which is very scary. And, you know, now we have a war. I mean, I don't think the war is it's just, we're going through a period where we went from a perfect storm to the upside to almost a perfect storm to the downside, because the Fed's like, oh my God, we're dealing with 8% inflation. We're going to have to crank the Fed funds rate really high. And that's what I think the market's really freaked out about. And the market's discounting and repricing everything.
So let me explain this from a sentiment perspective. I've been saying this in the rooms, I guess the first time I have a chance to say it on this show. I think it's related to the phase we're in, which I think is denial, right? Because I feel like I've seen this in the 2009 crash, .com crash, COVID crash. I feel like I've been there in all of those where it's obvious a crash is coming, but it just hasn't happened yet. And that's what I call denial. It's like everyone knows, hey, Apple's going to have to go down, but no one's positioned for it yet. No one's sold Apple up because they don't want to believe it's going down. So everyone's just waiting. They're like hoping, right? They know it's supposed to go down, but they're in denial. They're waiting. They're hoping. And then when, you know, they're just waiting for it to trigger, and then they'll pile in. That's how I explain it from a sentiment perspective.
Could be.
So,
Anyway.
all right. We got to move on because we're super late. Thank you so much for that.
Head out. See you guys later.
Enjoy your vacation. I appreciate your time. All right, great. Thanks. Hey, for you those listening on YouTube or social media, make sure to follow us on YouTube, on Twitter, on Spotify. But we're going to hang out. We're going to end the recording here, and I'll just take like a minute or two to see if there's any questions. Thanks for joining us.